The fundamental objective of financial management is to maximize shareholders' value in ethical decision making. So you will find the difference that the objective of financial management is not to maximize profits. So we are going to see the difference between finance and accounting, right? If we have a profit in an accounting way, it doesn't mean to the financial management team the business is doing well and the shareholders' value is maximized. We have cases of companies which reported good profit and soon after they collapsed, right? So we need to understand the objective, the main objective of financial management is to maximize shareholders' value. Maximize shareholders' value in terms of what? As we're going to proceed, you're going to see that the company has got two forms of capital. There is what we call equity capital, equity, and there is what we call debt, right? So you find that a company can be composed of these two types of capital. We're not talking about a company that has got maybe 100% financed by equity, right? We can have a company that has got two capital. So this capital is capital contributed by the owners or the shareholders, right? Shareholders. And this is, okay, I can admit here. And this is borrowed capital. This is borrowed capital. Borrowed capital, right? So you see, as you start your business, maybe it's you, maybe it's Lana to the, she started a business, right? And the business is doing well, then thinking that, I need to expand. Maybe I need to buy another farm. I need to buy another machinery, maybe to process chicken. But we do not have enough money, right? Then they go and borrow. So that borrowed money is debt. So borrowed money debt is compensated. Those who give you money that you've borrowed, they are compensated through interest payments. You give them interest, right? You know, your creditors, your bank, you've borrowed money, you give them interest. What about these guys who have put in their money into the business? They've put the money into the business, right? You see these guys, they'll be given dividends, right? But apart from dividends, they also gain from the capital gains or from the increase in the price of the shares. So one of the important things when it comes to management or financial management is to improve even the share price of the business, the value of the business. So as the share value is increasing, is improving, you are maximizing shareholders' value. So you will see that most of the things that we will try to do under this module is to how can we maximize the shareholder value of the firm, but in an ethical decision manner, right? Because you find there is a proclivity or a penchant to feel just to be driven by profits and maximize shareholder value at the expense of other stakeholders, right? I'm sure I talked about the profit, I talked about the planet, I talked about the people. So in financial management, we are not only concerned about maximizing shareholder value, which is related to profits, but we are concerned about the planet, which means our decision should be ethical. We should be corporate citizens. Our decision should reflect our concern to the environment, right? To the environment. So we should not just be interested in making profit, but polluting the environment. We should not just be interested in making profit, but using child labor or forced labor or unfair remuneration to our employees. It also goes beyond our company, but it proceeds to the whole supply chain. The whole supply chain. Our suppliers doing the right thing, are they not engaging in forced labor or child labor? Right? Because Christopher says, I'm sure it's Christopher, if my memory serves me well, it is not the businesses which compete, but supply chains, right? And I was saying that one of the times, if you go to buy a product online and you check the reviews, you might just choose not to buy a product because of reviews, because the rating is low. But some of the reviews are not directly to the product, but it's a frustration regarding the delivery, right? The actual company who supplies the product might not have any problem, but the delivery team might not have done the right thing, deliver on time, or maybe they failed to handle the product. But when we are judging you, we do not judge to say that company is separate from the delivery. Since you're working together, you are in the same pot. We are going to judge you to say this. We just provide a review, an overall review, 2, 3. Then we say the delivery was what. So if sometimes you don't read the reviews, you might choose to drop maybe a good product. So which means to say, when you're in financial management, our ethical decision goes beyond even our own company, but also to check our suppliers, our retailers. Are they doing the right thing? Are they pursuing ethical decision? So shareholder value and ethical decision making. Financial management focuses on maximizing firm value, not just profit. So firm value, that's what we're talking about. Also improving share price, right? The share price is going up, capital gains are like that. Shareholder value maximization is a core principle of financial management. Ethical decision making and corporate governance plays a crucial role. As some of you are doing RSK 4802, risk governance and compliance, you are going to see that there will be a time when we're talking about the corporate affairs, companies which failed, right? Like the Stenoff, right? Because of poor governance, the Enron, right? You have a lot of companies. Even if you think of your Barings Bank back then, you find that there are a lot of companies which failed. If you also want to, you might also want just to start to understand more about these things. If you go to our YouTube, if you do not have a link, I will send you, just let me know. There is a documentary there titled Inside Job, right? You find that it explains a lot about what happened during the 2008 global financial crisis, or prior, which led to the 2008 global financial crisis. And you will see a failed governance in that, which can help you to understand how the corporate governance work and how management of business can develop greatness to pursue their personal objective at the expense of other stakeholders, like even the shareholders, or even the customers, or even the depositors if it is the bank, right? So you can watch that documentary. Is interesting to someone who is in financial management and risk management. So ethical decision and corporate governance plays a crucial role. Okay, we're still under the aspect of shareholder value maximization. So we are saying the objective of financial management is to maximize shareholders' wealth. Efficient markets translate this into maximize share price, right? So we think of efficient markets, right? So they will translate this into share price. So if the share price is going up, we believe that management is doing good work. Both management are acting as the agents of the principal who are the shareholders, right? So we are saying here, every investment or financing decision should aim to increase shareholder value. So every financial management decision or financing decision should aim to increase shareholders' value. So you are going to see one of the key topics that we're going to look early is capital budgeting. And under capital budgeting, we'll do things like NPV analysis. Capital budgeting is also called, we also call it investment appraisal, right? So we want to check if a certain project is going to add value to the shareholders. So we are not calculating the profit on that project, but we are calculating the net present value. That net present value indicates whether the project is going to add value to the company or not. So I say every investment or financing should aim at increasing shareholders' value. All right, let's talk a bit about ethics, governance, and the stakeholders. So we are saying maximize shareholder value should align with ethical decision making, which we are saying that we should not be only profit oriented, but we need also to check the aspects of the people, of the planet, right? To say, as much as we're maximizing shareholder value, are we not doing that at the expense of the people, of the employees? Generally, we expect a person to work 8 hours a day and 40 hours a week, right? But if your employees are now working 12 hours a day or 10 hours a day, maybe 7 hours a week, maybe, we now say that as much as you maximize shareholder value, but you are not doing it in the right way. You are polluting the environment. You are not concerned about the planet, right? You are using harmful pesticides as a farm or as a big food processing firm. You are not doing the good thing as much as you're maximizing shareholder value. Corporate governance ensures sustainable value creation. So when you're talking about sustainable value creation, are you doing your things in a way, are you doing your business in a way that you are not affecting the environment, or you are not affecting the present capability to offer its fruits or its goodness to the next generation, right? If you are polluting the environment as much as you are making profits or maximizing shareholder value, you are depriving the land, you are depriving, right, the planet, the environment of its ability to offer the same good environment, to offer the same to the coming generations, right? So we need to create, we need to be concerned about sustainable value creation, right? Are we also not doing child labor? That's not sustainability. We are affecting other communities. I heard about the other companies which the parents are they just be taken into promised work, but that's the last time to see their kids, right? And those companies might be feeding their resources or their raw materials into big companies, and that's not right. That's not good governance. Companies must consider employees, their stakeholders. Are you remunerating well? Companies must consider their employees, their community, their suppliers and customers, right? Are you remunerating well when it comes to the employees? Also, maybe with terms come to the government, are you a corporate citizen? Are you paying your taxes well, or you are evading taxes? The community, you know, in economics, we talk about negative externality. As long as you're operating within a certain company, in a certain environment or community, there are some other externalities that we are causing. I'm sure you still remember as we are growing up, making some developments, the community is not yet developed, and then I still remember. We can see that here where this house is built, here where this industry is, here where this big company is, we used to play football on that ground, or we used to use it as a shortcut to go to church, as a shortcut to go to school, as a shortcut to go to the hospital. But because this company is now there, we now have to take the longer route, right? That company, as much as it's good, but sometimes if I'm not employed there, I'm not benefiting anything. What they've just done is to make my way longer going to school. They've got big cars. They've got excavators and the like, which emit a lot of carbon, right? They make some noise, right, when they're doing their processing, and our house is located just near them. They're externalities. But if they have nothing to offer to the community surrounding at the end of the day, that's not nice, right? So that's other negative externalities. So as such, companies do not operate in a vacuum, right? As such, they also have to offer some sort of appreciation, right? They have to consider that the community, as much as they might not be philanthropic, philanthropic responsibilities or social responsibility, maybe in terms of the scholarships, maybe in terms of community support, maybe reduce drug abuse, maybe also maybe supporting maybe the youths, maybe the women, and then as much as they are not doing that, right? But they have also to be considered about the environment also, at least not just emitting a lot of carbon, right? But the community has to be supported. That can be also through corporate social responsibility, right? You are doing some projects, you are also supporting the community from the problems that's suffering, you are also advocating for for zero gender-based violence. They're also advocating for youth to move out of streets and stop drug abuse. Your suppliers, are you also in good books with your suppliers? Are you also asking your suppliers to use the right raw materials? Are your suppliers not engaged in forced labor? Are your suppliers using the right pesticides if they're in agriculture? And your customers, are you also concerned about your customers? Is your business, your food processing, are you doing the right thing for your customers? Even if you are a bank, are you giving the customers the right information, or you just want to make profits? If you watch the document that I've told you, you'll be able to see much. Let's proceed. Limitations of profit maximization. So, when you're in accounting, we are mostly driven by profit, right? But here, when I talk about financial management, we are talking about maximizing shareholders' value, right? So we are going to see the difference. So what are the limitations of profit maximization? So making a profit does not mean the business is actually doing very well all the time. So profit maximization alone is not a suitable objective for financial management. Right? Why? Risks of focusing only on profit. What are the risks of only focusing on profit? The risk is that manipulation of accounting profits. If you make a mistake of focusing on profits can be manipulated, books can be cooked to meet what you want to see. Right, we have a lot of companies which did a lot of fraudulent accounting reporting, right? Just to window dress, to make it as if to seem as if they are performing well. So accounting profits can be manipulated while the business is struggling. Ignoring long-term sustainability. You can be making a lot of profits now, but what is your future? A company can be making little profits, but most of their money they are investing in machinery, they're investing in research and development, right? So they should not be a drive for instant gratification at the expense of long-term sustainability. Impact of accounting policies on reporting profits. Also, accounting policies can also impact the reported profits, which might also not really reflect what is in the underground. Guys, are we together?
Yes.
Well, let's proceed. Okay, time value of money. Time value of money. What is time value of money? Let's see about time value of money. Time value of money and cash flows. Time value of money and cash flows. Profit maximization ignores the time value of money. Alright? So we are going to see here in financial management, we are going to talk about time value of money. Alright? TVM. So if you go to our Facebook page and you want to go ahead, you can go and also watch a video on time value of money. So just also engage with also our other platforms so that you'll be able to get some of the information that we'll be sending, posting there, even on our we call it LinkedIn. So we are saying profit maximization ignores time value of money, right? So when we're talking about time value of money, we are saying a rand today is more valuable than a rand tomorrow. What are we saying is that 1 rand that I get today is more valuable than 1 rand that I get tomorrow. What are we saying? Let me put it in these terms. If you receive 100,000 rand today, this 100,000 rand is more valuable than if you receive the same 100,000 in July. Do you see it, guys? Let me give you a simple example. Another example. If you received 100,000 rand in 2010, it was much valuable. It's much valuable than receiving 100,000 rand today. The concept is that if I get 1 rand or 100,000 rand today, I can take it and invest in Tesla shares or Capitec or Attack, right? And maybe, surprisingly, the share price went up. Tomorrow, that 100,000 is now 105,000. You get it? If you read about Google, I'm sure it's Google, initial public offering. We'll talk about initial public offering. When Google issued the shares for the first time, there are people who bought shares, I'm sure, in the morning. Maybe let's just say for $70, $70 rand, but I know that was not the price, right? In the evening, the same shares were something like maybe 100. So basically, there was something like 18% gain. So just imagine your friend owes you your big money, and they just gave you in the morning, you bought the shares, and at the end of the day, there is an 18% gain. But if your friend disappointed you and not give you, you have lost that 18% increase. So are you getting what I'm saying? We are saying that the money that you receive today is more valuable than the money you are receiving tomorrow. Why? Because when you receive your money today early, you have the ability to invest it and you gain more money. Even also the aspect of inflation. In 2010, this 100,000 could buy a lot, but today, the same 100,000, if you got it in 2010 and put it under a mattress, it cannot buy you as much because money can lose value over time, right? Due to inflation. Money that you get today, early, you can invest it and it accumulates profit interest. So, profit maximization now, if you are just blinkered to profit maximization, accounting profit, it ignores the time value of money. Are we together?
Yes.
Well, okay, let's proceed. Okay. We are saying corporate finance prioritize cash flows over accounting profits. Corporate finance prioritize cash flows over accounting profits. Right, corporate finance. So corporate finance, when you hear corporate finance, is just the financial management. I'm sure you understand that in other colleges, financial management is just the same. That's what they refer to corporate finance. So corporate finance, that's financial management, right? So corporate finance prioritize cash flows, as we're going to see when we're doing our calculations. Cash flows over accounting profits. So cash flows, we're trying to also put into account the aspect of risk, right? Like inflation is a risk. We need to take note of inflation risk. Over accounting profits, they to say we've made 10 billion, but if you consider the risks, investment decisions should focus. Investment decisions should focus on cash flows rather than reported profits. Investment decisions should focus on cash flows rather than reported profits. What are the cash flows? Taking into account the risk, the cost of capital, as you are going to see. Okay. Cost of capital. So what I'm talking about, I'm sure I mentioned cost of capital, but maybe you might not know about it. That's what we're talking about now. Cost of capital consideration. Profits do not account for cost of equity financing. Cost of equity financing. Remember, we said a company can be financed like this. It has got equity. It has got debt. Right. So I said profits do not account for cost of equity financing. So you're saying equity here, this is the money that has been the money that has been provided by the shareholders or the owners of the company. Owners. You know, these owners, they've put their money. They also need a return. You cannot just put your money in a business, invest, and you don't expect to get a return. There's also a required rate of return. There's a return that they expect. These guys, they receive interest. They're covered, right? They receive interest. But what about these guys? So if we just blinker towards accounting profits, we forget that the shareholders also need to be considered in terms of their equity they have provided. Growth in earnings per share may not indicate increased shareholders' value. Growth is in earnings per share, because earnings per share, we are thinking in terms, actually we have not covered some of the things. We are thinking in terms of our net profit and the numbers of shares that we have. So it does not reflect shareholder value, as we are going to see. Opportunity cost of shareholders' funds should be considered, right? Because when you're talking about also the need for share price increase and maximize shareholders' value, we're saying that when shareholders put their money into the business, maybe each shareholders put 100,000 rand right into the business, they also need a compensation. Why? Because this 100,000 could have been used for other better opportunities which could yield better returns. So opportunity cost of shareholders' funds should be considered, right? So they also need a return. These guys, we know their return, they are going to be compensated in terms of interest, debt. Okay, let's proceed. Risk and value creation. Shareholders prefer lower risk and stable returns. So I'm saying, under normal circumstances, the owners of the business or the shareholders prefer lower risk and stable returns rather than to always be motivated or be carried away by the need to have higher returns, which definitely calls for higher risk. So shareholders usually they just want lower risk and stable returns. So even if you're thinking of investing, maybe you're going to look for lower risky companies, maybe stable returns. Maybe you're going to look around your MCG, fast moving consumer goods, right? Maybe you Pick and Pay, you ShopRite, those stable companies. I'm not saying all of them are stable, but usually the industry is considered stable, right? Well, let's proceed. Investment should balance risk and return. Investment should balance risk and return. Why? Because in risk, right, and in finance, we always say there's a trade-off between risk and return, right? This is something that we really enjoy in risk management and finance. Higher risky is the probability of offering possible. It's a possibility of higher returns. Low risky, lower returns. Before getting to the much of financial management, I'm sure you can just see this by saying cash under a matrix is low risky or cash in a bank is low risk, but it's also lower returns. Right? Do you know the cash that is under your mattress or in your bank account has got low risk? There's no way to think it might lose much value or you lose it. We're not talking about theft, alright? But there's no return actually. It will remain the same. If it is 100,000, it is 100,000, right? So there's low risk, low return. What are the things? We're going to talk about treasury bills, government securities. They've got low risk. We don't expect the government to default, but there's also low return, right? But now if you choose now to say, I want to take my money and invest in shares for ShopRite, Pick n Pay, Ataki, FNB, Capitec, you are buying stocks with your money. You are buying shares, right? There can be higher risk and higher returns. You can the share price, maybe buy stocks for Tesla, right? You can find that you wake up and find, whoa, the share price has gone up very high, right? Then you'll be enjoying. But there's a possibility that you can invest in a company that is even manipulating the profits, and you wake up and say, oh, the share went down from 200 rand to 1 rand 25 cents. You have lost a lot if you have invested a lot of money. Right? Because there's risk in these companies. Right? So there's higher risk, there's higher return. We will talk about derivatives later, especially in FinFo to international financial management. They've got higher returns, extremely higher returns, but higher risk, and higher returns. So you find that shareholders investment should balance between risk and return. Right? So at the end of the day, it's not just being driven by higher returns when the risk is too much. In your RSK 4801, those who are doing, I know you can't do all of this. RSK 4801, those who do, right, they will talk of what they call risky appetite, right, and it's set by the board, and they set it as they will have a document which they call a risky appetite statement. A risk appetite statement, it is a document, it is which explains the amount of risk the organization is willing to take in pursuit of its objectives. Right. So you see, we are saying that as much as we want to make returns, we need to make sure that the risks that we are taking is within the risk appetite. The amount of risk that we are willing to take in pursuit of shareholders' value maximization or objectives. So investment should balance between that risk and return, not just taking any possible project which could be very risky, but does that project risk fit in within, does it fit within the risk appetite of the firm, right? Then we go increased. Let me change the color of my pen here. Increase the risk without corresponding return may lower company's value. You see it. So if you increase risk without corresponding return, you can lower company's value. So you need to balance. You can just not accept excessive risk without a compensatory return or an additional or reciprocal return. I'm sure together. Decision making in financial management. Decision making in financial management. Financial decisions require evaluating risk and return. So you're going to see that we'll talk a bit also about expected return. Right, expected return, which is also a measure of the return that we're talking. And we are going also to talk about risk also in terms of standard deviation. There are times when we're going to talk about risk in terms of standard deviation. We're going to do the calculations later. So information systems and modeling tools assist financial managers in evaluating risk also and return, as we're going to see. Decision making involves acting without perfect knowledge or outcomes. Right? So even when you are doing your decision making in terms of evaluating risk and return, sometimes you do not have enough knowledge and perfect knowledge. So you will find sometimes you also use historical data and also subjective analysis. Maybe you are trying to check the returns of a certain stock. Maybe you're using historical data, maybe you're saying 50%, 70, 40%, 10%, maybe minus 15%, then possible a probability of getting back 0.2, 0.3, 0.1, that would be 4, 6, maybe 0.4. Right? I'll talk about this, do not worry. So this is the data that will be used to calculate expected return. But we're saying that those returns, and to say return risk, how do we calculate them? We use sometimes historical data because we do not have perfect knowledge, right? Decision making involves acting without perfect knowledge of outcomes. We do not know what is going to happen in the future, right? We also use historical data sometimes and subjective analysis, right, when we're making decisions. So we are not going to be so sure about what is going to happen because there are also some other risks that can happen in the future that we are not aware of. Achieving firm value. Achieving firm value maximization. Management should make investments that exceed the cost of capital, right? The cost of capital, which is comprising cost of equity, plus cost of debt. Equity, money contributed by the owners, debt contributed by the creditors or the lenders, the banks. Right. So your return that you have to get when investing or on a project should be greater than the total cost. You are going to talk about this later when you are calculating weighted average cost of capital. Right? So the return that you are getting on a project should exceed the cost of borrowing money that you have invested into that project, because you borrowed money to put in that project and you are charged 10% by the bank. And cost of equity, maybe the shareholder, they say, we want maybe 7% on our invested money. Now, in general, we are saying the returns from a project should now exceed the cost of capital for you to be saying you're running the project well and it's giving profit. Well, let's proceed. So, reducing the cost of capital increase firm value. If you've got ways to reduce cost of capital, wow, that's good. It can also help the firm. So you're going to see reduction in the cost of capital. We'll look at it later. You can find ways even of balancing between debt and equity, right? Providing a reasonable balance can also help you to reduce the cost, right? Also, even finding the best finding debt that is cheap, it can also help. We're going to talk about that later. Example, companies using debt securities to lower financing costs, right? companies can use debt to lower financing costs. Right? Let me just in a moment connect one of my cables. Okay, let's proceed. Okay, let's proceed, guys. Let's proceed. I'm sure I'm now audible. Are we together?
Yes.
Well, that's fine. Okay, so we're saying company is issuing
yes. Okay.
Well, that's fine. So I say company is issuing debt securities to lower financing. You are going to see that debt can also help to reduce the costs of financing. We are going to see that later. It's striking also a balance is important. So generally what we are saying, guys, is that maximizing the value of the firm is a result of choosing investments, right, with returns that are higher than the cost of capital, the cost of financing. So maximizing value, right, value return, it should be a result of returns which are greater than cost of capital. Maximize the cost of capital, maximize the investment return. Minimize the cost of capital, maximize the investment return. So to achieve the goal above, you need to choose investments with returns that are greater than the cost of capital. The cost of capital, which is the sources of finance that you have used to invest into that project, which the money that you have used to start a project or to engage in a project, the cost of that money should be less than the returns generated by that project or the investment. So maximizing the value, the returns should be greater than the cost of capital. So minimizing the cost of capital will maximize the investment return. So what are our key takeaways? Financial management focuses on maximizing value, firm value, not profits. Ethical and governance consideration ensure long-term sustainability. So ethical governance consideration ensure long-term sustainability. Well, we talked about the ethics. Financial decisions should balance between risk, return, and stakeholders' interest. So stakeholders' interest, we are saying we have those shareholders who also want a return. We also have the creditors who have given us the funds. We also have the employees. We also have government. We also have suppliers, which should not also be harsh on our suppliers because we want to maximize shareholder value. Then we squeeze our suppliers to sell us the product at the lowest cost. At the end of the day, they will compromise quality. That quality will go and even affect the other stakeholders who are customers because you are forcing them to sell you at a lower price. So, as much as we are also maximizing shareholder value, we need also to balance between risk and return and consider all the stakeholders. Because here, the creditors, if you are now moved by the goal of maximizing shareholder value, you can engage in a risky projects. But if you engage in risky projects, what's going to happen is this. What will happen is you are having high profits but high risky. At the end of the day, what's going to happen is this. Some projects might fail, right? If the project fails and things does not go well, you fail to pay back the creditors or the lenders. You fail to pay back their interest, right? When you fail to pay back their interest, it becomes a challenge. But let's assume you engage in excessive risky projects, high risky projects, then you make a lot of money. That lot of money, you are not going to give it to the debtors or to the creditors. You just give them their interest and that's all. You are not going to say, wow, guys, to the bank, we made huge profits, so we want to appreciate you and give you more money than the interest that you've charged. You take it for yourself. So you see, when things go right, you enjoy your money alone as shareholders and you just pay the creditors or the lenders their interest. But when things go bad because you are engaged in excessive risk and you want to maximize shareholder value, and there's high risk, you disadvantage the creditors. They are not going to get their interest. I'm sure we're together there. So guys, that was the first party. Are we together on that first party?
Why can't you, because of the higher returns that you're getting, why not pay off the principal and not just the interest? Because in the long run, then you're looking at it from time value of money. The principal is going down, the interest will eventually reduce because the interest that you're paying on the principal is lower.
Okay, so you're
in the long-term strategy.
Okay, so you're talking in terms of paying back the lenders.
Yes.
Okay, so when I say pay back the lenders, right? We are talking about both the principal and the interest. When you are saying you are paying back the money that you've borrowed, right? So when you are saying a borrower has default or failed to pay back, we are saying they failed to pay back the principal plus interest, or maybe they failed to pay the interest, right? So when we're talking about paying back the loan, right, we also include the principal. But when we are just talking here like now, we are more emphasizing on the interest, right? On the interest. Why? Because that's the charge, that's the cost. This principal, you got it, guys, and that's the money that you are using, right? Maybe for a project, but there is a cost of that money. You got 100,000 rand, right? And you have used in your project. So paying back the 100,000 rand is not a problem because someone gave you that 100,000 rand. So when we are discussing, we must talk about the interest, maybe the 1,000 or the 10,000, which is the interest charged on this 100,000. Because paying back the 100,000 rand, yeah, it's a fair deal because you received it, right? But the 10,000 rand now, it is the interest charged on 100,000 rand. So when you're saying you are paying back, you are also paying back the principal. So the principal and the interest. Are we together?
Sort of, but yes.
Oh, okay, that's fine. Let's talk about economic value added, EVA, and financial management. Measuring value creation for shareholders. Measuring value creation for shareholders. Economic value added is a performance metric that measures a company's true economic profit. That measures the company's true economic profit, not just accounting profit. It focuses on value creation by considering the cost of capital. So economic value added is a good metric because it considers the cost of capital. Unlike accounting profit, economic value added ensures shareholder value wealth maximization. So it is better metric because it takes account cost of capital and ensures maximization of the shareholders' value. We are going to look at it. So let's explore economic value added. So economic value added is net operating profit. We are going to see that when we are going to do our calculations. Net operating profit. Alright? After tax, net operating profit after tax or no part. Minus capital invested. So when you are doing a project, you realize that when you are doing our project, we have what we call initial capital outlay, or maybe you can say cost of the cost of the project or machinery, right? Maybe it's machinery that you've bought, right? Maybe let's assume it can be 50 million. So it will be negative 50 million, right? And there will be cash flows that you receive. Maybe 1 year, first year you expect to make sales of 10 million, second year 25 million, third year 69 million, fourth year 21 million, maybe fifth year 72 million, and the like. So it will help you in calculating the cash flows and the like. And there is capital invested, right? Here we're saying multiplied by weighted average cost of capital. So weighted average cost of capital, I'm sure for now you do not understand it if maybe you forgot about your undergrad maybe stuff, but we still remember we calculated by finding the cost of debt and the cost of equity. So it's weight of debt multiplied by cost of debt plus weight of equity multiplied by the equity multiplied by the cost of equity, right? So we're combining the cost of debt and the cost of equity, right? So we're saying economic value added is net operating profit after tax, no part, minus the capital that we've invested, maybe that 50 million, right, multiplied by the cost of capital, that which you are going to calculate first. So it indicates whether a company generates returns exceed its cost of capital. So the advantage of an economic value added, it helps us to see if the company is making returns or generating returns that are above its cost of capital, which includes cost of equity and cost of debt, right? A positive economic value added means the company creates value. A negative economic value added signals value deterioration or destruction. Okay, we will look at that also with calculations later, right? Because now I know if you just do some calculations, you might also need to understand how to calculate our cost of capital and the like. So do not worry. Importance of economic value added, it aligns management decisions with shareholders' value creation because it takes into account cost of capital. It also encourages efficient capital allocation, not just borrowing, not just investing, shareholders putting in their money and you are using it inappropriately in a project that is not adding value to the company. It may be just be interested by seeing profits, accounting profits. Helps in performance evaluation and in incentive compensation, right? Also help in evaluating performance because we're saying you are doing well, you are doing projects which you have retained that exceeds cost of capital. And if there is need for compensating management, the compensation will be fair, right? Because you are doing a good job. Let's talk about economic value added versus traditional metrics. Unlike net profit, economic value added accounts for cost of capital. So we know our normal profit and loss statement, or maybe our statement of income, right? You know, it does not take into account cost of capital. We just go to our net profit. If it is positive, we're happy, right? But we need to take into account cost of capital. because that profit can be eroded because of the cost of capital. As such, economic value added is a better metric than the traditional metrics of just using our profit and loss statement. Earnings per share and return on investment can be misleading if capital costs are ignored. Right? They can be misleading, as we are going to see. Economic value added provides a more accurate picture of financial performance. It provides a more accurate picture of financial performance because it takes into account the cost of capital. So, some of the things you might not understand it like much of now, but you will see that you are going to have a separate topic on cost of capital. A topic that is in its own on cost of capital. And it's an important topic which you can find in the examination. Can have 20 to 35 marks. So we're going to look into all of these. Factors affecting economic value added. It can be revenue growth. Higher sales will increase NOPAT, which is net operating profit after tax. So from our formula here, you see if this is higher, definitely our economic value added will be higher. So we are saying that revenue growth, higher sales, increase net operating profit after tax, operating efficiency, cost management boost profitability, right? Capital structure, optimizing debt and equity lowers work, and if our work is low, then our economic value added is likely to be higher. Investment decision, project must earn returns above working. If returns are also above working, then it's a good thing for us. Economic value added and shareholder value. Firms maximizing economic value added achieve sustainable shareholder wealth because they have the ability to progress, right? They are sustainable. They are investing in projects which have got a higher return than the cost of capital. Economic value added guides companies in reinvesting profits or also distributing dividends. Also, economic value added driven firms focus on long-term financial health rather than short-term accounting profits gratification. How do we apply this in decision making? Economic value added is used in capital budgeting to assess investment viability. Right? So you see, we will link this with NPV later. All projects with positive NPV should be considered. All projects with negative NPV should not be considered. If we go back here, we're saying a positive EVA means company creates value. A negative means destruction or deterioration. As such, companies should only consider projects with a positive EVA. Companies should consider projects with a positive economic value added because it creates value. Negative economic value added, it destroys, it deteriorates, it distracts the value of a firm. Right. It also helps in financial restructuring by identifying underperforming assets. It also guides executive compensation to align with value creation. If there's no value, why do you need so many peaks in the higher returns as executives? What are also the challenges in economic value added? It requires accurate calculation of cost of capital. We are going to see that we're going to do calculation of cost of capital. But we'll say we need to understand how do we calculate cost of capital accurately. Because inaccurate calculation of cost of capital can provide a misleading economic value. Because we need the cost of capital in our calculation of economic value added. Can be complex to implement across diverse business units. You know, you've got different businesses and the like. It might be difficult to implement it. Because different business also units have got different also risks sometimes. Short-term economic value added may conflict with long-term growth strategies. That's also possible. You're dealing with the short-term economic value added, right, which can not reflect the long-term growth strategies, right, and you might even forfeit some other projects because you are just blinkered on short-term economic value added. So what are our key takeaways? This aspect of economic value added, I'm sure we will be able to understand it a bit much when we are going to do an example. And I also believe that when we have an appreciation, when you do capital budgeting, when you have an appreciation of what is cost of capital, in particular, just the calculation of what we are going to do, just a bit of economic value added. So you see what we meant. Economic value added is a powerful tool for measuring financial performance. It ensures companies generate returns above their cost of capital. By focusing on economic value added, firms enhance financial decision making and shareholder value. Right. I'm sure we are together. Are we together there, guys? Before we move to the role of the financial manager.
Yes.
Well, let's
together.
Well, that's fine. Thank you, guys. So now let's look at the role of the financial manager. The role of the financial manager: investment decisions and financing decisions. Investment decisions: identifying and pursuing wealth creating opportunities or projects. Right? So when I talk about investment decisions, identifying and pursuing wealth creating opportunities, we are just thinking in terms of projects with returns, right, greater than cost of capital, right, positive EVA projects, identifying and pursuing wealth creating opportunities. That's also aligned with also maximizing shareholder value, right? Also financing decision, securing funds to finance investment. So as much as those investment decisions, we need also finance decisions. How are we going to fund these projects? Because we can have many projects, many good projects, but we need finances. We need to finance those projects. So the idea now is to say the financial manager should source the funds. Maybe there are debt capital. You will see, as we are going to do cost of capital and capital structure, you can issue bonds. You need to have strategies to source funds. Issue bonds. You can look for loans, right? You can choose to issue shares on the Johannesburg Stock Exchange. It is your role because you want to finance the project. You see, we cannot borrow at the moment. We cannot borrow because we have a lot of debt. So what we can do, we need more equity. How are we going to go about it? We need to issue shares on the Johannesburg Stock Exchange. How many shares? At what price? Those are the decisions of the financial manager. So the financial manager, in other terms, you find this guy being called the chief financial manager, right? Who is the financial manager? Typically, the chief financial officer holds this role. The CEO and the executive team are often involved in the finance decisions. So finance decisions are very important. As such, you find the CEO and the executive team work hand in hand with the chief financial officer, right? Because these are key roles of the company. These are key activities. So they work hand in hand. Okay, I'm sure this slide can come to an end very soon. The role of the financial manager. These are the roles of the financial manager. Right? Let's start here. The role is to explore investment opportunities and explores investment opportunities and makes investment decisions. Right? There's operating assets, non-current, current and current. Here, financial assets, we'll explore that in detail. financial assets, right? On this other side, we are saying they explore financing opportunities and makes financing decisions. Capital markets, we are saying capital market, it is the market for long-term borrowing, more than a year. Equity market, we can just think of the Johannesburg Stock Exchange. That's where you can buy and sell shares. So the equity market, the financial manager can use it to make money, to get capital in the form of equity by issuing shares. Debt market, under the capital market, you can issue bonds, right? That's where you can get borrowed capital in a long term. Money markets, this is a market for short-term borrowing. Right, under this market, you are borrowing for less than a year. It is a market for borrowing or investing for less than a year. So you find that you can have working capital challenges, right? Maybe you do not have them, you did business with certain companies and they have not yet paid you back. They have not yet paid, right? But you need money to pay salaries, to buy stationery. You can go into the money market and just borrow some little money for short term, maybe 3 months, and pay back. That's the money market. So for this slide, guys, we are here. Any questions on what we've covered so far?